Most retirement advice was built for a stable world. Steady inflation, predictable markets, bonds that paid real income. But today, inflation moves fast, interest rates swing. Markets react to headlines and hours, not years. And the old 4% rule was built on data from a different era. So, what happens if the world we retire into doesn't look like the one we planned for? The answer may be simpler and more conservative than most of us expect. For decades, many retirees followed one simple idea: withdraw 4% of your portfolio each year, adjust for inflation, and your money should last 30 years. That worked well in certain historical periods. But we don't retire into averages, we retire into sequences. If the first few years of retirement bring market declines, high inflation, or weak bond returns, early withdrawals can quietly damage a portfolio. This is where it gets uncomfortable. The risk isn't just market volatility. It's something deeper, it's timing. And that's why many planners are now discussing a more cautious approach, the 3% rule. Sequence risk pressure. What is it? Sequence risk pressure is the danger of withdrawing money during the wrong years, especially early in retirement when markets are down. Why does it happen? Because retirement portfolios are not just about average returns. They are about the order of returns. If you retire at 65 and the first 3 years bring a recession, your portfolio shrinks while you're still taking withdrawals. That smaller base then has less power to recover when markets rebound. In the US, someone retiring in 2000 or 2008 felt this sharply. In the UK, retirees during the 1970s inflation crisis faced a similar strain. And here's the part most people miss. It's not about panic, it's math. When withdrawals meet early losses, recovery becomes harder. How do we reduce this pressure? The 3% rule lowers the withdrawal rate. Instead of taking $40,000 from a $1 million portfolio, you take $30,000. That 1% difference creates breathing room. It reduces the strain during bad years and increases the odds your money lasts longer, especially in unstable periods. Next thing is inflation drift illusion. What is it? Inflation drift illusion is the tendency to underestimate how long high inflation can quietly erode purchasing power. Why does it happen? Because we anchor to recent memory. For years, inflation in the US and UK was low. So retirement plans assumed modest increases. But when inflation spikes, like it did in 2022, fixed withdrawals lose real value quickly. But here's what most people miss. Inflation doesn't need to be extreme to cause damage. It just needs to stay elevated longer than expected. A 4% withdrawal adjusted upward every year during high inflation can accelerate portfolio depletion. The 3% rule builds in a buffer. It assumes uncertainty. It respects that inflation can surprise us, and that small margin can mean the difference between adjusting lifestyle at 85 or not. Let's imagine Sarah. She's 65, retiring in the US with $1 million invested in index funds and bonds. Her home is paid off. Her annual expenses are about $60,000. Under the 4% rule, she withdraws $40,000 per year, supplementing Social Security. Now imagine her first 2 years include a 20% market decline and inflation at 6%. Her portfolio drops, her withdrawals continue. Her inflation adjustments increase spending. The recovery window narrows. Now consider the 3% rule. She withdraws $30,000 instead. She adjusts more cautiously. She keeps a larger cash buffer. Her portfolio has more time to heal. It's not exciting, but it's resilient. What you can do instead: stress test your plan, run projections at 3%, 3.5%, and 4%. Include high inflation and weak early returns. Many retirement calculators now allow scenario testing. Don't rely on one average assumption. Build a flexible spending layer. Separate essential expenses from discretionary ones. If markets fall, reduce travel or luxury spending temporarily. Flexibility increases survival odds. This is where discipline replaces prediction. Create a stability bucket. Keep 1 to 3 years of expenses in cash or short-term bonds. This allows you to avoid selling long-term investments during downturns. It's not about timing the market, it's about reducing forced decisions. The 4% rule was never a promise, it was a guideline based on history. But history changes, economies shift. Inflation moves in cycles. The real question isn't whether 4% still works. It's whether we're willing to plan for a world that may be less stable than the one behind us. The 3% rule isn't about fear. It's about margin, and in retirement, margin is freedom. If you value calm, evidence-based thinking about money, subscribe to VaultWise Daily. We'll keep exploring how to build wealth that survives uncertainty. Because stability isn't found in predictions, it's built into the plan.